If you're putting money down for retirement, this video will help you avoid mistakes that some people make without even realizing it. Everyone is seeking a quick and easy road to wealth and happiness, whether it's picking a winning stock or expecting to win the lottery. Striking it rich is especially appealing to patient young investors who believe it will take forever for their investments to develop at an average rate of return. Uncertain tactics may work, but most people accumulate wealth gradually and consistently without taking large risks. Before you hand over your first chunk of cash, here are some tried and true practices that investors should follow. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Make long-term investments. Long-term investing is the most effective technique for increasing growth while minimizing risk. One of the primary advantages is that it helps your portfolio to expand despite short-term market swings. Day trading or short-term investing is dangerous since equities rise and fall very quickly and sometimes for no apparent reason. Long-term investments also provide the benefit of compound interest, which can outperform your active income in many circumstances. You may want to explore holding real estate for a long time to benefit from long-term appreciation and cash flow increases. Once you've chosen an investment that you feel good about, it's better to set it and forget it and continue investing year after year as your equity grows. In the words of Warren Buffett, you're making a terrible mistake if you stay out of a game that you think is going to be very good over time because you think you can pick a better time to enter it. Remember that being in the market at the right time is more important than being in the right place at the right time. Don't let your emotions get the best of you. Another hit or miss method is to choose an investment vehicle based on emotion. Continue to invest even if the market falls. Too many people panic when the market collapses rapidly and feel compelled to sell. Instead, think of downturns as a bargain on the equities you hold or wish to own, and have faith that the market will return. In contrast, when their investments grow in value, many investors feel terrific and want to buy more. This may not be a good idea because the same quantity of money should be invested on a regular basis. When one of the worst financial calamities struck in 2008, the Dow was down 34%. The market eventually recovered and has subsequently offered a healthy profit for those who waited out the turmoil. Those who liquidated their entire portfolio when fear and terror struck were likely to have lost a significant portion of their retirement savings. When it comes to long-term investing, the emotion of terror is not helpful. Select stocks over bonds. If you save money, you can buy bonds, a farm, an apartment or house, or a portion of an American business, Warren Buffett adds. And if you purchase a 10-year bond right now, you're paying more than 40 times earnings for something that can't grow. When you compare it to purchasing equities, good businesses, I don't believe there is a parallel. The whole stock market's long-term average return has been roughly 10%. A 10-year bond currently yields less than 3%. Warren Buffett believes that stocks have long been more appealing than bonds, and that betting on the American economy would not disappoint. Long-term investments in thriving enterprises will yield a large return when multiplied over and over. Take a look at how stock market investment has made Buffett one of the world's richest people. Invest with minimal fees. Fees are frequently neglected when comparing different forms of investments, but they play a significant role. According to Tony Robbins, if two people each have $100,000 and one person pays a 1% cost on their mutual fund and the other pays a 3% fee, the person paying the 1% fee will have roughly double the money in their account over time. According to Forbes, the typical mutual fund costs 3.1% per year, which is a significant amount when compared to the average index fund, which charges only 0.2% per year. To save even more money, consider acquiring assets through commission-free brokerages such as Robinhood. Pay close attention to the fees you pay, as they could cost you hundreds of thousands of dollars. Avoid using leverage. High-risk investors will borrow money to invest in the stock market, gambling at the expense of finance capital, which will be repaid by the stock's appreciation returns. For example, Borrowing $5,000 from a lender at 5% interest may be a beneficial investment if the $5,000 in stock gives a larger return than 5% interest. This is dangerous, and if the value of the stock purchase falls, the borrower will still owe the money. It's exactly like gambling with a bookmaker. If the gambler loses, the lender still receives the money. Leveraged investments are most usually associated with real estate, particularly rental properties, but they can also refer to acquiring stocks on leverage. While the profits may be better with more leverage or a larger mortgage, there is less room for error if there is a market downturn or a halt in rental revenue due to unanticipated circumstances. Indeed, Dave Ramsey went from wealthy to penniless in his 20s owing to overleverage and now promotes debt-free living. Be reasonable in your expectations. Have you ever heard of an unbelievable property development deal? The site turned out to be a useless marsh rather than great commercial development land at an insider's discount pricing. What about that stock tip you heard that's predicted to triple in value? If you hear about a stock that promises a ridiculous return, don't walk away. Instead, run. This is almost certainly too good to be true. Be realistic about the expected returns on your assets. The stock market has returned an average of 10% over the last 90 years. So don't blow your life savings on a risky investment. Keep in mind that slow and steady wins the race. Diversify your investing portfolio. Diversification is strongly advised unless you are a skilled investor, because each economic disruption is unique. It is hard to foresee what the next one will be like. Having a diverse portfolio will protect you when one area performs poorly and reward you when specific areas succeed. Diversification does not have to be difficult. In fact, it is possible to diversify with only one fund. If you only have stocks, consider investing in real estate if you know what you're doing. To be safe, someone who just invests in real estate should also buy some equities. You never know how the next financial disaster will affect your life savings. It is critical to thoroughly evaluate these aspects of investing in order to optimize your profits. Investing for the long run and keeping your strategy emotion-free will help your account perform well over time. Be realistic about the results you can expect and avoid being greedy. Diversify not only your investments, but also the accounts in which they are stored. Follow these steps to avoid costly mistakes and ensure a successful investing career for years to come, whether you're just starting out or want to enhance your profits. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?